Alright, it's Chen Chen here, and today we talk about the topic of tax for real estate investing. So, why we need to talk about tax? Because for you, if you want to investing in real estate, no matter it's your part-time or full-time, actually you can form up with a company, which means that LLC or anything else, no matter it's sole proprietor, partnership, S corporation, or C corporation. And from this book, the Real Book of Real Estate actually is from US. So by the way, we still can talk about the tax law of US also, because around the world it's almost the same. But that's better if you have collaborate and partner with a tax advisor, so we can change the idea very much one. So let's say if you are in real estate investing, you want to increase your ROI, which means that return of investment. So because of tax, actually they tax the property earning is from the profit, right? So actually you know how to play with tax, it can be increase your ROI. So how can you do it? And then the first tip from this is, when you collecting the rental, and your property is collecting rentals, and or you part-time or else, that's better you use sole proprietor or partnership. Why are we going to talk about that? Because when you want to do refinance, if you use S corporation, which means or Singapore, it will tax you higher. And one point is that, and then the second point is when you sell your property, after that it will tax you higher. So for rental, and if for a person who want to refinance your property, that's better you choose to invest in your real estate for sole proprietorship or partnership. Then what about S corporation or C corporation? And that's better for people who are real estate dealer or real estate developer, because for real estate developer, actually they running the real estate investing is like a business already. So they sure need minimum is a sale corporation, because everything else they sell the property and all in business purpose. And or for people who want to buy fix and then sell it also, S corporation is very suitable for you because of the tax advantage. And this is the entity structure or all that. So the next point is, you will know that the tax actually is taxed by the profit, right? So when you go out, actually you can put your entertainment fee as your cost. No matter you go to travels, you go to watch the property, and then you do eat the dinner, everything else that you can state your tax. And then a little tips is, that's better you use your business account to pay for the meal or the debt, so that you can put on your expenses. So this type will increase your expenses, so your profit will be much lower, so your tax will be much less from the profit. Not just that is, and got one type is depreciation. Actually you can state in with tax law, you can treat your property will depreciate about 20% every year, so you can put as an expenses, so that you can reduce your tax. You still need to pay the tax, so but we can still reduce it and then make our profit high. And the last thing is very important is documentation. We talk about all the tax law and all the depreciation, all the entertainment fee, so your accounting all must be very detailed, and all is be well prepared and do well. If you don't know how to do, that's better you have your tax advisor, accountant, you work with them together. So come up with best documentation. It will help a lot and save a lot of money, and you can increase your ROI. That's for return of your investment. Alright, that's for today. See you.